curtailing menu and impacting their business on the whole.
Absolutely. Well, market open coming up, and I think it's going to be slightly better. It's about 1% higher, 24,230. 0.8 now, 0.79. But I mean, this is the first few seconds. Nifty Bank is up about 1%, 1.25. I mean, the Nifty Bank ended about 3% lower yesterday after Friday's sell-off. And the selling in Nifty Bank is more recent, much more stronger as compared to the Nifty over the last many months. The mid-cap index is up 1.5%, and I think the small-cap index will come up. And there, too, it should reflect what's happening across the board. Strength, 1.5% through and through is what you have in the broader markets. 0.8 settling about 190 points higher. That's the Nifty heat map. Almost everything should be in the green. There's Indigo, which is coming up the most. There's Asian Paint, Tata Steel. I mean, some of the same names, which of course got sold because oil went up, are recovering as oils come off. ONGC, Reliance, Cipla, HCL Tech are the losers. Just 4 names in the red. Everything else is up, and about 160, 170 points is what you have. I mean, it's strong, but markets will be tentative. They will be, I mean, it's basically back to headline watching with regards to getting more confirmation that this is really coming to a close. And, energy starts passing through that region once again, which is still not the case. But 24, 180, 24, 190 on the Nifty. Rima.
Well, sectorally, it's the auto names and the PSU banks. They were hardest hit yesterday with both the sectoral indices closing down with a cut of 4.5%. You are seeing a rebound there. So the Nifty PSU banking index, 2% up, followed by auto, 1.9%. Metals is seeing a relief rally today. That's got a gain of about 1.9%. Banks are higher. The Nifty banking index is up 600 points, but it pales in comparison to the brutal sell-off that it had yesterday when it was down nearly 2,000 points. In terms of individual stocks, Interglobe Aviation, top gainer, 3.5% higher. Asian Paints up 2.7%. Again, relief rally seen after the decline in crude prices versus where it was yesterday, but though Brent is still at $93 per barrel. Ultratech Cement, Shriram Finance, L&T is seeing a rebound. In the metal names, it's Tata Steel, which catches your attention, Adani Ports, Tata Motors Passenger Vehicles, Eicher Motors, M&M. In the banking names, it's ICICI Bank, State Bank of India, all support gaining more than 1%. On the way down, you've got oil and gas names. So ONGC, Reliance Industries are the top 2 losers with a cut of 1.5%. And some tech names are on the back foot. No deep cuts, but red on the screen for an Infosys, flat when it comes to Tech Mahindra and HCL Tech. The Nifty gain now stands at about 140 odd points, and compared to yesterday's intraday low of 23,700, we are staring at about a 450 point recovery. Though again, the gains are there, but not a runaway rally.
Tentative, the way Prashant put it, because at higher levels we are seeing some of a sell-off. The important part is that a lot of individual stocks are doing extremely well. So look at Dixon Tech, the HKC partnership working well for them. The stocks bounce about 5.5% straight off the bat. We have Escorts Kubota as well. Sudarshan did tell us about the Kotak note on them being positive. So that stock's higher. There's a joint venture for Minda Corp. That stock is up around 4%. Additionally, in the bulk deal disclosures yesterday, we had Pirojsha Godrej go ahead and buy some stake in personal capacity in Arvind Smart Spaces. The street is viewing that favorably for that stock. So Arvind Smart Spaces is up around 5% as well. And on the way down, the interesting part is that while obviously the impact on a lot of these upstream oil companies would be on the way down. So ONGC is lower, Reliance is lower. But even as oil prices cool off, a lot of these sugar stocks are coming off. Sri Renuka, Dhampur, Balrampur, sugar stocks typically decline in a pack and rise in a pack as well. The way people were looking at it when oil prices were rising is that maybe ethanol prices would rise in conjunction as well. With crude going off highs, all these stocks are now also falling off highs because that ethanol trade now comes undone, and as a result of which we are seeing some declines on all these names. But by and large, looks like a very good opening so far from an oil standpoint, largely because a lot of these tire makers as well, which use crude as an input, are bouncing back. So JK Tyre, for one, is up around 3%. Some traction, what we've seen on Apollo and MRF as well. Market breadth firmly in favor of advances. But the question is, where do we go from here? The Nifty Bank bouncing from yesterday's low.
Absolutely. And it's 10:1 in terms of advances to decline. So 2,100 stocks are higher. And you have about 260, 270 stocks which are lower at this point in time. By the way, silver B's huge volumes and it's up about 3.5%. So some of these silver ETFs are doing very well. Dixon we highlighted. Tejas Networks had a sort of absolutely ripper of a rally, and then it sold off sharply as well from the highs. It's up 4%, large volumes on it. Our Systems was locked up, limit up yesterday on tremendous volumes. It's up another 8% right now. Hitachi is up 4%, so something to watch. Ashok Leyland is up about 4%. More silver ETFs which are up and about. KRN Energy is up about 5%. Force Motors is up 4%. MTAR Tech, Renu was talking about MTAR Tech. MTAR is up $1,000, I think, in the last 1 year. More, actually. So 3.6, 3.7%. Natco Pharma is up about 3.5%. So that's the state of play as we open this morning. Reliance, which went up 1.5, is down 1.5, and RIL is the top loser on the NSE 500 on volumes as well. Actually, volumes on Reliance out, very, very large. So almost 1 million shares coming through on a name like RIL at the word go. Lawrence Belanco is with us of CLSA. He's, of course, one of the most watched technical analysts in the world. Lawrence, good morning. Great to have you with us here. Thanks for joining us. I mean, just absolutely mind-bending moves, right, with oil and oil. So let's just start there because that seems to be what is driving everything, Lawrence. Is there any way to tell which way we are headed and what's your forecast here?
Yes, I mean, what we did, we looked back at Gulf War I, Gulf War II. We also looked at the Russia invasion of the Ukraine, and what our observations were is that obviously while you get the initial spike in oil, what we've seen in the other episodes is that oil reverses fairly sharply and ultimately drops below the level that the conflict started at. So, in this case, we started at the $72. We had the massive spark up just short of $120 yesterday. And that intraday reversal is the first signs of, buying exhaustion and the potential for now a reversal in the Brent price with the first level of support now sitting at the $81 to $82 area. And then back to the $72. I think even if we get some stability at this $82 area, our base case has been that you want it to be fading this move higher in Brent and looking for it to move back to the $72 area.
By when, Lawrence? Lawrence, by when? 72 by when, in your opinion? What's the timeline here? I mean, if there is
you've seen the speed at which these markets move at. It can be in the short term, as long as you continue to get a de-escalation on the Middle Eastern side. It's very difficult to give you a time horizon around that. But like I say, out of all the observations that we've made with major conflicts in the Middle East, is that oil has reversed back below the starting point. So, ultimately, we think this goes back to 72. And last night's price action looks quite meaningful, and that's one of the bigger intraday reversals that we've seen for Brent. If you go back to the 7th of March 2022, it was a 11% intraday reversal. If you go to Midnight Hammer, which was the operation run last year in June, it was a 12% reversal. And like I say, in both cases, oil reversed back below where the conflict started.
Yeah. Just one last question on this, Lawrence. Have you heard sort of any chatter, indication of, governments being involved with sort of, that's last night, with in oil markets, traded oil? Any indication, any chatter of that? There is some on social media that said, I'm not sure.
Yeah, I mean, so I've just seen the headlines coming through on the news wires of the G7 meeting for the special reserves release.
No, Lawrence, I don't mean actual oil being released, but basically in financial markets to cool the price of oil, to kind of sort of to sidestep speculators, so to speak. I mean, intervention in markets.
I haven't seen any headlines sort of confirming that or seen any evidence within market action from that. If I look at overnight rates or anything like that, so I haven't seen any sort of typical tools that we've seen historically being used to suppress markets. And what I would highlight to you is that we haven't really seen any real signs of capitulation within the equity markets. If I give you an example, in the US markets, what we've seen since the outbreak of the conflict in the Middle East is more degrossing of positions. You've seen a strong rebound in the software names and a sell-off in the semiconductor names. And essentially, it's been an unwind of the momentum longs in semiconductors and covering of the shorts in the software side. So we haven't seen that one-sided volume sell-off to the downside that historically has given us capitulation selling. So if anything, the markets have been quite resilient in line with the headlines that you've seen.
So it's more of a position unwind rather than full panic capitulation that we're seeing in global equities. Lawrence, hi, morning. Rima here. What about the Indian markets? We've been consolidating now for nearly 1.5 years. Yesterday, we almost got to a 10% correction from our recent peak levels. What are the markers on the Indian markets and the near-term, medium-term call?
Yeah, I mean, it's interesting that yesterday we managed to close back above the highs that we saw in March and April. And that was quite important because that was the basing pattern that we saw in the first quarter of 2025. And that level sits around the 23,800 to 24,000 area. So yesterday's intraday reversal of the session's lows to close above this level and today's follow through to the upside essentially keeps the Nifty consolidating in this range that runs from 23,800 all the way up to the 26,300. And that's been the range, as you rightly say, of the last 12 months, the Nifty has been consolidating. And so it's important that we respected that support area and it just leaves the market in a consolidation pattern rather than giving us any evidence of an imminent breakout. But holding that level, I think, was quite important because closing below 23,800, there's no major support until you get down to the 22,000 area. So that's the critical line in the sand here that we continue to respect and hold above 23,800 at the end of the day.
So when we get to, say, Brent at $72 per barrel, do you sense a breakout in this consolidation range for the Indian markets?
So ultimately, yes. The important thing is that in this phase of uncertainty, we continue to hold that 23,800. And on a longer term basis, breaking above that 26,300, we have a number of targets, starting at 28,800, but ultimately stretching up to the 41,000, which has been our end of the decade target for the Nifty. But if we just focus on the shorter term side, 23,800 is important. We could spend another 3 months at least consolidating in this current trading range. But the constructive point is that we've respected support so far.
Right. So 23,800 is an important support. We bounced from there. The next important supports that you speak about is between 24,300 and 24,500. We need to cross past that for us to, go around that 26,300 to 26,350 sort of mark that you've been speaking about. Right now, we're about a 400-point distance from the 23,400, 500 mark. And I'm talking about just here and now, obviously not medium to long term, where the markets are poised to do well. Do you think because of the reverse polarity in nature, as of now, in the very near term, this 24,400 to 24,500 mark could prove to be a bit of a resistance?
Yeah, looking at the bounce that we're getting, I think we can actually test that 25,500 area on this initial rebound. And then obviously I think the shorter term swings will be dictated is to the headlines around the Middle East and those oil price moves, right? But in the near term, we're getting a relief rally that should see us move back towards that 25,500 mark.
And chartically, what is your call on the Nifty Bank if you track that one? And alongside that, outside of equities, what about gold?
Yeah, so I mean, disappointing that the Nifty Bank Index yesterday did close below its 200-day moving average. So this is the first time that we've been below that since March of last year. There is some support that kicks in around the 53,200 to 53,300 area. But I think that damage below the 200-day now at least suggests a period of repair and consolidation there. So the 200-day now acts as resistance or immediate resistance at the 57,646 mark. But that was an important sort of deterioration in the NSE Bank's price action yesterday. So question on gold, our base case is at the January peak. We need time to digest those explosive gains that we saw into that January high. We think that you've got a floor in place around the 4,600 to 4,800 area. And in prior bull markets that we've seen in gold, for example, the 99 to 2008 moves, there were 3 phases that you corrected for a 6-month period before you had the platform for the resumption of gold's longer-term uptrend. And we think we're likely due a number of weeks consolidating here. But any weakness within this current consolidation pattern, we think you can accumulate gold, but you shouldn't expect an imminent break to new highs. We think that is more than likely a September, October event for a breakout to new highs. So currently in a holding pattern and consolidating.
We're seeing big moves in the Asian markets as well. Kospi in particular, circuit breakers on the way down, then leading the regional rebound. What's the price action telling you in the regional markets? Which is the strongest looking chart right now? And how would India fare over the medium term versus the other emerging markets?
Yeah, I mean, in fact, you've seen India outperform the emerging market index by 5% since the 25th of February. And the reason why it's outperformed is that the North Asian markets in Korea and Taiwan have just fallen so much more than the Indian market, despite the moves in oil that has had a negative impact in India. So that has seen relative outperformance. But if we come back to the North Asian markets, both for Korea and Taiwan, the 18% pullbacks that we've seen in Korea, the over 10% pullback in Taiwan has really just brought those markets back to their 50-day moving averages. What we see here is, like we saw in October and November of last year, is a correction back to the 50-day consolidation pattern. And that should set a platform for another leg higher at the end of the day, assuming that we don't get a continual escalation in the Middle East. I think obviously that's an important caveat to that message, and the 50-day moving average being the key support area. So in relative terms, both Korea and Taiwan holding their 50-day and resuming their uptrends, we're likely to see India still be a relative underperformer in that scenario.
Right. You expect India to be a relative underperformer. Just a final question from my end, Lawrence. We did speak about the Nifty Bank. Let's talk about the other two components or major components of the index. The IT pack, which has been underperforming, though now resilient because of the weakening rupee and perhaps no other place for capital to hide. And the other part is Reliance. So if you have an individual stock call on Reliance and the IT index in India.
I mean, Reliance has basically been trading in a range between 1,300 and 1,600. We bounced off 1,300, as the oil price ran up, and we pulled back a bit. But 1,300 is key support on that Reliance charts. But we don't really see any imminent breakout outside of that trading range and holding pattern that you've seen it. The IT sector, while you've had some short-term support here, if you take a step back and you look at the longer-term profile, the weakness that we've seen basically from the February highs has seen the IT index break below the lows registered in 2024 and 2025, which comes through at about the 31,700 area. So as long as the IT index remains below that 31,700 area, from a longer-term side, a major top is in place for the NSE IT index that leaves it vulnerable to a continuation of that breakdown that points down towards 26,200. So despite the short-term stability that you've seen here, we have seen a significant breakdown in that index below the 2024 and 2025 lows.
Yeah. Sorry, got that. So there is IT and 31,700 there, and Reliance supported 1,300, but no imminent breakout. We've got a line going, India to outperform Asian emerging markets by 5%.
No, I think he said from some part in February, India has outperformed emerging markets.
I think we
so it's basically been from the 25th of February to date.
Yeah.
You've
So
seen
you're talking
India
about
outperform, and that's because it's fallen less.
Yeah, you're talking about historical. I mean, what's already happened, because what I heard you say is that India will underperform the Asian emerging markets. But
yes, so going forward, the fact that Korea and Taiwan are holding their 50-day, that sets them up for a resumption of those long-term uptrends, assuming we don't get continual escalation in the Middle East. And under that scenario, you've got another leg down of relative underperformance.
Yeah, we will just correct that line. Lawrence, just last question. Is there an accumulation list with regards to stocks in India? I mean, any names, 3-4 names which you think are...
From compliance side, we're pretty limited to sort of speak about individual names. Reliance, I've given you the support and resistance areas, but we'll have to keep it to sector levels. I mean, I would highlight the broader PSU space as a space that's continued to improve as we've started this year. And we are seeing relative and absolute performance despite some of the shorter term volatility. So I would single out that as a sector that has definitely improved through the first 3 months of this year.
Yeah. So this is overall PSUs, right? Not just banks, but everything.
Overall PSUs, that's correct.
Okay, got that. Thanks very much, Lawrence. It's a pleasure having you with us here, and really appreciate your time. Well, it's what 5:1 in terms of advances to declines. 2,200 stocks are higher and about 500 stocks are lower, just under 500 stocks are lower. So broader market is doing well, but volumes are, on the lower side. And as I said right at the word go, it's a bit tentative, right? I think we opened with about a 200-point pop, and about 100 points is left on the index now. So 24,123 is where we are at. The big story, Rima, of course, is of course, as Mangalam obviously has also been telling us, the LPG shortage with regards to that intimation from the Restaurants Association. And, LPG, as the MGL former chairman yesterday told us, Mangalam, it's a delicate situation. Yeah. Not natural gas, not PNG, but LPG in particular. Go on.
And in LPG, the important part is there are two kinds. One is domestic, the other one is commercial. And commercial, which obviously has a lot of resonance with the restaurant sector, is something which is under pressure right now. Restaurant and hotel bodies have warned of severe disruption as commercial LPG supplies tighten. The government has formed a panel to review representations for the LPG supply to restaurants as well, and as non-domestic sector. So to discuss this and more, we do have with us Sagar Daryani, who's the founder of Wow Momo, but more importantly, the president of National Restaurant Association of India. Along with him is Jignanshu Gaur as well, director and senior research analyst at Bernstein. Let's ask Sagar first. Sagar, from your business right now at Wow Momo, the number of outlets it operates, if you could tell us about the situation of LPG, and then speak a little about, the macro, the industry on the whole, the kind of supplies that they have and the impact that it may have.
We at Wow Momo, about 30% of our outlets would be dependent on LPG cylinders, and then we have gas pipelines, we have electricity. So from a QSR standpoint, the impact will not be as significant as it is at a macro level. I mean, the NRAI represents about 5 lakh restaurants, right? And I would feel that 80 to 85% of them depend on LPG cylinders. Now, this directive by the government, which says to give priority to domestic consumption, is well understood. But, there's no way that the government has mentioned that, commercial LPGs are to be banned. However, the narrative that the OMCs or the distributors are coming up with is that there is a ban. And what this does is, it just creates a shortage. It creates hoarding. It creates inflation of prices. It creates black marketing. And I think we could feel the impact yesterday from many of our restaurant members in cities like Pune, Bangalore, Chennai. And, we are very, very worried about the situation, because ultimately, we do fall under essential services, by the way. I mean, a lot of people use the LPG for domestic consumption, but a lot of people depend on restaurant food for their daily intake of food. So I think that is a clarification that we have sought from the Petroleum and the National Gas Ministry.
So Sagar, NRAI represents 5 lakh restaurants. How many of them are vulnerable to be shut down now because of lack of supply? Do we have any sort of numbers?
We did a poll yesterday, and from what we could feel is that 60% of them are worried about a shutdown if the situation is not solved within 2 to 3 days. So it is quite critical at the moment, and I think clarification is sought. We have written to the to the Petroleum and Natural Gas Ministry. We have sought FaceTime as well, but the situation looks quite critical, quite grim. I mean, our secretariat was part of a meeting yesterday that was held by CII, and the situation looked very, very, very grim, not just for the food industry, but for various other sectors. However, we feel food falls under essential services, and we really need a breakthrough here.
Right. Got that. We need a breakthrough. I mean, we as I was saying earlier, we spoke with the MGL former chairman yesterday, and he said, in times like this, what happens is on the LPG side and actually everywhere else, as he described it, non-essential industrial supply gets curtailed, but supply to retail, which is domestic households, etc., that is given priority. It's a tough situation in that sense. Hopefully it resolves soon. Jignanshu is also with us. Gentlemen, morning, Prashant here. Jignanshu, come in here. Your coverage universe from a market perspective, what are the implications?
I think similar to what Sagar mentioned, right? It's an evolving situation, evolving very quickly, almost by the hour, on the decisions which are being taken between the directives of the government and the distributors and the ONCs and everybody in between. which makes it dynamic and evolving. If this continues for longer, of course, it is negative for the QSR space as well as the food delivery space, as a lot of those restaurants which NII represents are also present, are the ones who are effectively selling on Eternal and Swiggy's platforms. Any disruption of supply there effectively disrupts the possibility of food delivery business growth as well. Right? So I think that is a risk in our view. Probably larger restaurants have more resilience for such supply shocks. When I say larger chain restaurants like Jubilant or Devyani or Westlife, etc., versus some of the unorganized players, will have higher ability to absorb these shocks through various levers.
No, I get that point. Jignanshu, in fact, as Sagar earlier pointed out as well, he said that QSRs are relatively less impacted by this as against the others. So from a listed company standpoint, that is a limited impact. For his own Wow Momo business, 30% of their stores only use LPG or will be exposed to that sort of shock. So the question then is for, those who are playing the larger restaurant theme via stocks like Eternal and Swiggy, how much of the supply impact could impact their food delivery business in the very near term? Would that be offset by, say, people ordering more from, places which are available right now, quick service restaurants, etc.? So a net impact wouldn't be as much. And if nothing, at least they have, quick commerce to look at some of the packaged food items. So to that extent, will the platform nature of these businesses keep them resilient to any sort of supply shock that may emerge from some of the restaurants which are, not doing well, purely from an investment standpoint?
Yeah, I think if you just look at the investment and forecast standpoint, we would say a combination of having a large base of restaurants supports both food delivery platforms, because even if some restaurants need to go out of offerings, there are others who can pick up the slack. Quick commerce also helps, but between the two, I would say Eternal is safer in some or lesser of a investment value shock than Swiggy is, primarily because in Swiggy's valuation today, we ascribe a much higher valuation to the food delivery business. So any immediate impact there can impact. Now, I think, of course, all of this depends on the extent of which this elongates, right? If it's a week or 2 weeks, probably the shock can be easily absorbed. If it's much longer than that, then who knows where this will end.
I think Tamil Nadu, when they wrote, they said that the restaurants in their state currently have gas supplies for a month at most, post which they will have to shutter their establishments, though Bangalore seemed to have hinted more of a bandh starting today. So, Sagar, you said that while there hasn't been an official shutdown from the government, the situation on the ground is different. There is hoarding which is taking place. The black market seems to be thriving. What are the prices of LPG cylinders now? If you go to purchase now, there was already a hike. And is cost going to be an issue also for the companies and restaurants?
That's what we fear. I think cost is going to be a very, very big issue. From the information that we got from our members in Bangalore, that the prices had gone up by 1.5 times in a matter of a couple of days. And, the problem is that our sector has, been largely affected in the last 1.5 years with pressure on margins, with pressure on, same-store sales growth. And as the revival starts, you get hit by another war, which leads to such crisis. So I'm sure it's going to impact P&Ls of various restaurants. But at the moment, more than the P&L impact, I think the concern is continuity of business, for like it was mentioned, the larger chains will be able to absorb the cost, but the smaller chains, for them, I think continuity is a big question, and I think that is where the panic is coming in from. Obviously black marketing, hoarding has begun. I think what we seek is for the government to come forward and issue a clarificatory that, it is not banned. It is just that priority is given to the domestic sector. However, commercial LPG cylinders should be made available. At the moment, the directive or the narrative or the circular that's gone out has made it a little ambiguous, which is not calling it a ban as such, but the OMCs or the distributors, not the OMCs, but the distributors of the OMCs are behaving in a way as if there is a ban and taking up prices to provide that supply, which is very unfortunate at the moment.
Sagar, just one fundamental question. Why is PNG still being rolled out to households, etc., across the country, so that network is still being built out? but it doesn't. Is there any thinking? I mean, my question is why don't restaurants use PNG? Is it more expensive in terms of capex, upfront costs, etc.? Is it about higher calorific value for LPG? So restaurants need that. I mean, yeah, go on.
To be honest, PNG is much more cheaper. It's much more effective. There are no leakages. There are no wastages. However, the PNG infrastructure in India is not yet developed to that extent. So PNG is largely available in organized commercial premises like malls, like tech parks, like residential apartments. But when you have standalone stores, there is no infrastructure ready in India yet to make PNG readily available to in each and every restaurant. Rather, PNG is not even available in many of the high streets, which have numerous restaurants together. So I think from an infrastructure standpoint, PNG is yet to be developed. We are quite far away from PNG being made available to any and every restaurateur. It is available in cases of malls. And that is why I mentioned that, 80 to 85%, depend on LPGs, because the remaining are, restaurants and outlets within malls, within commercial premises, which are organized and which have PNG facilities.
Got it. We'll leave it there. Thank you very much for joining us. Good speaking with you. And thanks both of you for being here on the program. We'll continue to track the story and hope you will join us to give us updates in terms of if the situation improves or not. But I think, Rima, we have the management of Borosil Renewables with us, and it's the same story, gas shortages.
Same story, yeah. Pradeep Kumar Kheruka, Executive Chairman at Borosil Renewables, is now joining in, and we'll focus on the following discussion points: the impact of the West Asia war on the supply chain, Europe bracing for a gas price spike, and the impact of the India-EU trade deal. But let's begin with the top story, and that is the fear of gas shortage. Thank you very much, sir, for joining in. Can you first tell us who is the primary supplier of gas for Borosil Renewables? Because, for instance, GAIL recently issued a force majeure. Has there been a gas supply shortage which will impact operations at Borosil Renewables?
Well, there is definitely a gas shortage which is looming now. The government is very well seized of the issue of gas because our furnaces run on gas, and we cannot suffer any cuts. We cannot work on 50% gas, for example. We need to have the full gas. I would say that the ministry is very proactive, generally speaking, and they have heard us carefully. And we do not have anything which is dangerous as of now. There is some cut, but we are able to manage with that. And we see that this should not be a problem for us.
What's the extent of the cut as of now?
As of now, even we are all right. We are functioning. So we are in urgent discussions with the ministry, and they have recognized what we have said. So as of now, there is no curtailment.
No, so the question is, you are managing because you have an alternate fuel backup, or you have on-site storage, or has there been no cut in supply, gas supply to your company?
We do have alternate. We have backup alternate fuel for our own company. For the association of which I am the president, for the other glass makers, some of them may not have backup. And so therefore, our discussions with the government are based on the possibility that there might not be a backup. There is always the possibility of curtailing supply of consumption in certain uses where something else would be used rather than gas. And I think we are looking at that. So, so far, it's going along. And we hope that it will go along, because we are dependent on our gas requirement to the extent of nearly half India's consumption. We do have our own production in India of natural gas.
Right. Mr. Kheruka, so there are two things to this. One is the availability of gas itself, and the second is the price at which it is available, right? So even if, the availability is present, but the prices, if it increases, or the alternates for that matter, could that have an impact on your margins? If yes, if you could give us a sense on the quantum of that impact, and is there a provision for you in these times to actually pass it on to the consumers?
So to answer your question, in fact, we have received notice that the contracts under which we were buying gas, which were at a certain price, have all been subjected to force majeure, and they are not in operation. Those contracts have been sort of suspended, as it were. So we are buying gas now, but that's at whatever is the ruling market price. And that situation is probably going to continue for a while. This will have a negative impact on our costing. There's no question about that. We have already discussed this with our customers, and we do not profit from such situations. We work hand in hand in partnership with our customers, and we try to limit the increase in price to the extent that's possible. And some of it we pass on to the customer. So that's the story here.
So a follow-up on that one then obviously would be one, what are the current prices for the product that you're selling right now? I mean, at the end of the third quarter, you did say to us it's around 54,000 a ton. Have there been any major upward or downward revisions to that? And secondly, if not, then what could the increase in your cost and as a result of which reduction in your margins be in the very near term? Obviously, medium to long term, the street will adjust, but you had a target of holding your margins upwards of 30% in the first couple of quarters since we spoke in the third quarter. So would that come under pressure, that guidance?
I believe that we should be able to hold on to our margins of 30%, I believe, for the rest of this month at least.
So
and,
do you have... Okay.
Hopefully, we see a resolution to this crisis. I've been speaking to some people who are very close to the center of action, I mean to say. And what President Trump has said, that it won't be carrying on for very long, about a week is what people expect. If that happens, then things should be all right. Meaning,
so what is the average selling... Sorry to interrupt. What is the average selling price for you in Q4 so far compared to Q3?
See, the last price we heard was $32, up from... we have a basket of prices. So we have one pipeline which is coming from GAIL. So we have just the one gas. The question is, the gas which is coming is metered. And part of that billing is raised by somebody, part of the billing is raised by somebody else. GAIL is our bulk supplier. So there are other people. So, you know, the price might go up nearly 2.5 times, I think, compared to what we have been paying.
Mr. Kheruka, hi, morning, Prashant here. I have a completely unrelated question, but I'm going to ask you, since I have you on the line, is there any are there any plans afoot, maybe initial, but the promoters, US promoters, are you looking to sell the business, sir?
No. No, we're not looking to sell the business.
Okay. Not now, not ever. Or was there any thinking of that sort at all?
As you know, many times when I've been asked questions, I always say I never make forward-facing statements. So the question is that, as I think everybody knows, Borosil is in many different businesses.
Yeah.
We have scientific glassware where we make plants which are which deal with chemical processes.
Right.
We have DRDO as our customer. We have ISRO as our customer. We have so many R&D centers as our customers. And that's an area which is very active for us now. We are also into pharmaceutical packaging. We're in consumer goods. So we're across a fairly wide range of products. And we're not sure which way, what is going to take off. But renewables is doing very well. So there's no real reason for us to consider selling this business.
Okay. And so nothing at the moment is what you're telling us, right? And no
I mean, nothing in the foreseeable future is what I'm telling you.
Okay, perfect. Thank you very much, Mr. Kheruka, and appreciate you sort of answering that. I had to ask it since I had you on. But I hope the situation on the natural gas supply improves and things look up as well. Thank you for joining us here on CNBC-TV18. We'll take
Demand remains very strong.
Yeah.
The government considers renewables to be a strategic priority.
Yes.
Wafers are made with electric power, so I don't really see the oil crisis impacting the entire value chain in renewables other than in glass.
Yeah.
And there, I believe the government will step into support. So that's my take.
Let's certainly hope so. Thank you very much once again, Mr. Kheruka. And thank you for joining us here. Well, we're going to take a quick commercial break here, and we're going to focus. We're going to go back from micro to slightly macro, top down. We have Louis Kuges of S&P Global Ratings joining us about the broader market, financial and otherwise implications of what's going on in West Asia. Stay tuned, coming up. Okay, welcome back. 90 points high. Actually, it's 80 now, 24,110. So still up, but not up as much as we were right at the word go at 9:15. And but that was to be expected, as we were saying. Things are still tentative, and if you hear some of the press conference which President Trump spoke at, he said a lot of stuff. And to a question I just saw, he said to a question of whether the war is ended or was it go on, President Trump replied cryptically, almost saying, well, it could be both things. So I think that's where markets find themselves at right now. But what are the implications of all of this on growth and inflation, etc.? That's essentially the question that we're going to tackle here. Louis Kugis is Chief APAC Economist at S&P Global Ratings. Louis, great to have you with us here in the program. Thanks for dropping by. So just that question, are you modeling any impact in, and what would that be?
Yeah, of course, we're looking at this all the time. But, just like you said, Prashant, we're all wondering and trying to have a base case as to how long do we think this conflict lasts, right? Because if this is only of short duration, then, yeah, you'll see the oil price spike for, a few days, a few weeks. But if it stays, if that's all there is, then the impact will be quite modest. As it starts to last longer, you start to really see the impact coming in. Like what we know from global conflicts in the past is that it's all about their duration, right? Because that's how it starts to kick into the real economy via higher inflation, lower growth. And then also, everything unfortunately is related, right? Because as financial conditions tighten, like equity markets go down, banks become more reluctant, that by itself will then also start to weigh on the economy. So there's quite a lot going on.
And what is if I ask you, how long will this go on? Do you have a...
In our company, we have something like a base case in terms of the duration, where we have said that our base case is that the most intensive stage of the conflict will, in our baseline, last for a few weeks.
Got it.
Something like that.
But if it de-escalates to lower intensity conflict, because the main channel through which this is coming into the global economy is oil prices, right?
At the moment.
But low intensity conflict can still disrupt oil supply, right?
For sure, it can disrupt oil supply. It can
it's 100 missiles or 10 missiles. But the point is, your tankers need to pass, right? There's physical safety involved. So what does that mean?
Well, so I'm not an expert in the market, but we have a lot of people as colleagues, and so generally people feel that the starting position in the global oil market was actually quite comfortable, in the sense that we started this year, 2026, in a situation with a bit of an oversupply almost, like globally, if you looked at demand supply. So yes, at the moment, a lot of stress because people worry that nothing will come out of that Strait of Hormuz. But if those very binding constraints are released, then low-intensity conflict where the oil is still leaving the Middle East will probably have only a moderate impact, given that we started from a relatively comfortable supply-demand balance.
What's interesting right now is, just as we speak, every dip in oil is being bought into as well, and the market's actually off highs. So this morning, the index was up by over 200 points, the Nifty that was, and now it's sitting with just a 70-point gain. And we had Brent at around $88, which has spiked to around 94. And as a result of which, the rupee, which opened relatively stronger as against yesterday, has now gone back above 92.13 against the dollar. The index, which is not doing well, is the IT pack, which was resilient yesterday, now selling off today. So Infosys and the likes should come up for you currently at the low point of trade. But from a general growth standpoint, what were you penciling in for India this year? And as a result of, the emerging situation right now, what could the impact on India's growth be and its, currency balance of payment sort of issue because of the rising crude prices?
Yeah. So the Indian economy, as you know better than I, is to a large extent driven by domestic factors, right? And so one of the key ways in which this conflict enters that whole equation is what it does to the current account, the currency, and what that then means for the central bank. Because the central bank, clearly, the RBI is mainly targeting headline inflation, which will come under pressure. So it is likely to make them, a little bit less likely to cut rates. And it is via that type of impact that we think the largest impact will be on growth. And then in the meantime, the market will wonder about the impact on imports on the current account.
So have you done any numbers to model that in?
We do like rules of thumb type models, like what if, and so clearly India comes out as a little bit more so generally speaking, Asian economies, not only India, but also economies like Japan, Korea, China, they are all large oil importers. Imported oil is a very large part of their overall energy picture. So they're very sensitive, and that's why you see when the market globally sells off, it is those Asian markets, and actually the Indian one was not even the hardest hit. It was even more like Japan, South Korea, where both the equity markets, but also the currencies then would come under pressure.
So let's talk about that base case, where you said that the intense phase of the conflict lasts for a few weeks. Well, even 2 weeks are not done as of now, right? So if the base case does play out, say 4 weeks, right, another 2 weeks from here on, what's going to be the impact on emerging markets, the countries that you track in terms of inflation, growth expectations, etc.?
At the risk of sounding cavalier, I would still think that another 2 weeks of intense pressure on the oil market is probably not going to have a major impact on inflation in the rest of the year, if that's all there is. But of course, if it means another 2 week intense and then still lasting impact, then it will start to affect that. So it is really still a question of how long will it take. A few weeks is manageable because as you know at the moment, for instance, in India, right, retail prices of fuel haven't been all that much affected. It is a lot of intermediaries, the companies that take the hit in terms of their margins. So they will not continue to do that, and the government won't let them do it if it lasts for a few months. A few weeks is doable, but yeah, it's really a question of duration.
Richard, so just to take off that point on India specifically, I mean, any specific thoughts here with the rupee, with the, we're a big importer, right? We import 80% of the oil that we use.
Yeah.
And we're still, oil is still more expensive. It was $40 more expensive at the highs. Now it's $20 more expensive from before when the conflict started.
Yeah.
So how does this change things here? There was already a little bit of concern that maybe, the budget, etc., is a little tight. In India, the budget math, not very much room, and this kind of sort of aggravates that problem.
It does. And clearly you see the impact on the currency as well. I would say, though, that, the Indian currency had already been weakening quite a bit recently, and so that provides a little bit of a buffer in the sense that the currency is not overvalued, right? And so that means that sometimes, especially in emerging markets, authorities are very reluctant to let the currency weaken, and then they can't hold it, and there is a big impact. Something like that we will not have because the currency had already been allowed to weaken, and so I think that helps a little bit in terms of that buffering. If you go back to India's own history, say 15 years ago, I think the same oil shock would have had a bigger impact because the starting current account deficit was higher. Also, in the real economy itself, there was less ability to buffer and cushion. So I think the Indian economy has matured in a few ways that helps, absorbing a shock like this.
Just a final question before we let you go. And the nature of the headlines changed so much that right now we're talking about the impact of war on the economy, but a week ago we were talking about the impact of artificial intelligence on productivity and GDPs across the world. So have you done any math on that as well? And do you have any thoughts on artificial intelligence and its impact on maybe labor-sensitive economies and how it goes?
Yeah, I think that is still, as we say, as economists would say, it's still, an empirical question. How much, how many jobs will really be become obsolete? Like will be say how many labor will be displaced by AI and what will happen to that, right? The optimists say it will raise productivity. The pessimists say people will become unemployed and it could even create upheaval. I think if you look at history with a broad brush, the optimists are right in the sense that over time, technological progress helps raising productivity and living standards, but that's a broad brush. And in the meantime, you can have quite a bit of dislocation. And I think at the moment, we're really still waiting to see, because everybody is talking about AI and how it changes their business model. In the meantime, not a lot of people have been laid off.
Mangalam, if there are no jobs, more time for you to play paddle, pickle, more time for you to...
No money for me to buy equipment for sure as well, but, be that as it may, thank you so much. You said the optimists say a certain thing, pessimists say a certain thing. The truth, as always, is in the middle. What we'll do is get a better handle on the commodities segment as we take that short break. Come back. Manisha Gupta joins in.
Thank you for joining.
Thank you so much, Louis, for coming back to our studios.
Right.
Okay, I think we should take a quick break, right? And Manisha should be with us in just a bit from now. Commodities in focus, and I guess it's I have a suspicion it's going to be oil in focus. Stay tuned.
Welcome back. Let's talk commodities. Crude prices, which tumbled below $90 per barrel in the morning, are now surging once again. Manisha gets us the latest.
Oh, well, yes, absolutely. Very, very volatile prices, very different from what we started the day yesterday. Yesterday was 22% high. Today, we've started 10% on the lower side. So we started the day for the crude oil prices at $88 a barrel, nearly 11% on the lower side. We've gained since then almost 95 on your screens, and just about 4.5% of a decline is what we are dealing with right now. So yesterday, prices did see a high of $120 a barrel, with markets betting that you could see it higher. Remember, the all-time high for the Brent prices is $147 a barrel, which markets believe if this war prolongs to 4 or 5 or 6 weeks, you perhaps could be looking at those levels as well. But for the very near term, most people tell me that it is going to be between 75 to 125 of a range that the crude prices could trade within. Till time in 2026, we've traded between 60 to 120 of a range already. So $60 of a range is what we've done till time, with nearly 55% of gains in prices. Well, the reasons for surge in crude prices clearly have been the near closure of the Strait of Hormuz, that is where 20% of ships or oil comes in from. The second major point has been production shutdowns in Middle East. You have various countries now getting added to the list, from Bahrain to Saudi Arabia, UAE, Kuwait, Iraq, have all started to shut production as the storage facilities have started to fill near many of these countries. Many of these countries also have started filling crude to the ships, but they're not moving anywhere. So there is that storage getting built up. The reason that you have seen a profit-taking or a correction in crude prices has been after the U.S. president signals that the war with Iran may be nearing an end. Again, did not give a timeline to that, but that is a statement there. Also, the U.S. military operation is progressing ahead of its initial timetable is a statement that Trump gave. It also is about the waiver on oil-related sanctions. Now, that is one major thing that has led to prices correcting there. Remember, the geopolitical premium in prices has been much higher. We've gained from 60 to 120. So even at 95, the premium continues to be quite on the higher side there. The U.S. Navy will escort tankers through Strait of Hormuz. I mean, these are some of the statements that the U.S. president has come out with, and you have seen those reassuring statements continue to weigh on the prices there. The G7 finance minister statement yet again was quite positive. They stand ready to release oil from strategic reserves if necessary. Again, no timeline, no quantity coming in there. The Russian president also did tweet out sharing proposals with U.S. aiming at a quick settlement to the Iran war. So all that we saw in last 24 hours were various statements from U.S. president, from Russia, from G7 ministers, all of that reassuring markets. Nothing really has changed on ground, but these statements clearly did the tick. Apart from that, it is the probability of a 40 basis point of a monetary easing from the Fed by the year end is something that the street will watch out for. For this week, though, when it comes to data, it is going to be the U.S. inflation numbers that would give you further strength.
All right, Marija, thank you very much for that. That's a roundup of where commodity prices are at incredibly volatile, but also some of the factors to watch out for. Well, we'll take a quick commercial break here. Our special segment is the economy. Lata in conversation with economists Supasna Bharadwajan of Kotak and Aditya Nair of ICRA on oil shortages and, of course, the implications for Indian economy.
Welcome back. Crude had surged to $120 billion this morning, 88 and now $94 per barrel. What does all this mean? Here's one plate we got from the State Bank of India research, which says that if crude in FY27 average $90 per barrel, then the inflation goes up from their old estimate of about 3.7 to 3.9. GDP falls to 6.8. And as you can see, 100, the moment crude goes above 100, at $120, CPI shoots up to 4.8% and GDP comes down to almost close to 6%, 6.2. Well, these are various estimates that are coming. Let's get two top-notch economists to tell us what they make of the possibility of the impact on Indian macros. Joining me now are Upasana Bharadwaj, the chief economist at Kotak Mahindra Bank, and Aditi Nayyar, the chief economist at ICRA. Ladies, thank you very much indeed for your time. Aditi, I just got your report as well. But if you can take us through what your fears are. We have to assume that crude may not be 100, but the average for FY27 could be 90 perhaps, if the risk premium continues. What is the impact on various Indian macros?
Thank you, Lata. And you're certainly right. Even though like $100 or $125 per barrel may have been an extreme case that we have put out in our report just to put out the numbers. But certainly crude oil could end up averaging a fair bit higher in FY27 than our baseline estimate, which was $70 to $75 per barrel. Now, in terms of the macros, all of them will get impacted by different degrees. To start with, the net oil import bill, for every $10 that the average crude oil price increases in FY27, the net oil import bill would go up by 14 to 16 billion. And therefore, the impact on the CAD would be 30 to 40 basis points. And of course, this would have an impact on the currency. In terms of inflation prints, it would depend on what is the extent to which pump prices are revised. But for the WPI, where generally transmission tends to be quicker and more complete, we would expect that for every 10% increase in crude oil prices, the WPI average would go up by 80 to 100 basis points. And our baseline for this year was 2.7%. For the CPI, here the extent of transmission to the RSPs is extremely important. If there is full transmission, which is not at all the base case, we would expect that the CPI would go up by 40 to 60 basis points for every 10% increase in the average crude oil price. But I'm again stressing that is not our base case, that there will be a full transmission. And our base case for the CPI inflation for FY27 is 4%. So any increase would be over that.
Okay, I get your point. Upasana, now for the more tough question. I mean, these are scenarios we can build. But at the moment, we have a sentimental pressure on the rupee. We started off at 91 in the morning on news that, the crude prices have fallen because of some Donald Trump statements. But the rupee is back again at 92.15. So realistically, should we be prepared for some worsening of macros, not to the extent of $90 and $100, but are we in for higher fiscal deficit, higher current account deficit, and lower growth in FY27?
See, Lata, let's look at the numbers that we're talking about as on 27th of February, the Friday for which this entire thing started. Crude oil prices were around $70 a barrel, plus minus here and there. Today, we are still $24 higher. Even though we are lower than the worst that we've seen recently, but it is still higher. Now, the point is, how low does it go from here? So clearly, our base case of $65 a barrel, which still remains for now, of course, but there is an upside to that. And as Aditi pointed out, for every $10 increase, there will be pressure on our macros. So if we settle, if the risk premium to our crude oil prices do not come back to $65 a barrel or plus minus here and there, then clearly there is an upside to the risks are there to our macros there. And we do see some kind of an issue there. And as you mentioned for rupee, clearly the belief that this war is, I mean, we have seen a lot of volatility around this. We are kind of held ransom to the tweets that come overnight. At the moment, I think the markets do not fully believe what is there. Nothing on reality has changed for the moment. So I guess in the near term, sentiment will remain a little wobbly. As a result, we may not see too much respite on the rupee front.
Okay. Let's drill it down to markets. At the moment, would you say that the chances of a rate cut henceforth are completely gone? Or would you pencil in even a possibility of a rate hike or at least a yield hike for banks?
The question is to me, Lata?
Yes, Upasana. To the banker here.
Clearly, I think if these issues were to persist, then the possibility also, if it existed, for a rate cut is now out of the picture. I don't still see that the rate hike probability should go up right away. As I said, it's a volatile situation. We will have to wait and watch that if this crisis was to last at least for 2-3 months, that's where the probability will increase significantly.
One minute, Upasana. Maybe I messed up the sentence. A rate hike may not be there because we are now talking about 4% CPI, even with an increase in pump prices. What I'm asking is whether yields will go up. What are banks sensing because of this upward pressure of prices?
Yeah, so there are two things to be kept in mind. I think one is how aggressive RBI has been in the recent days in terms of the OMO purchases.
Yeah.
Of course, the 1 lakh crore has been announced. But apart from that, even in the secondary market, RBI has been very aggressively buying bonds. Now, that is something which has really supported the bond market sentiment. More so at a time in March when auctions are done with. So the supply of GSEC is not there. Now, going ahead, if this problem was to persist, obviously there will be a fiscal pressure. Bond markets will further come under pressure. And the balance of payment too will start getting deteriorated from here. So the need for RBI to act more aggressively will also be there. So there will be upside to yields, but probably it will be to an extent capped also by RBI presence.
Okay. Aditi, since Upasana spoke about fisc, and I wanted to come to you on that. Are you distinctly seeing a higher fiscal deficit, not just this year? This year it is because of the arithmetic. The nominal GDP has come down. But next year, there will be probably lower dividends from oil marketing companies, as you point out in your report. So if the earnings are less for the fisc, do you expect actually higher borrowing? Not just a percentage fiscal deficit, but actually total borrowing going up?
Lata, the way we see it for the remnants of FY26, but mainly for FY27, the three key areas where the fisc will get impacted will be the fertilizer subsidy, because the inputs going into fertilizer prices, I mean, that is definitely something that we're very watchful of and very wary of the way that things are moving. Second is the overall impact on the dividends that the oil marketing companies would be able to give to the government of India. And here again, the average crude oil price and the marketing margins for petrol and diesel, the retail sales prices, all of this will matter in terms of the impact on the fiscal math. And the third is overall what will be the impact on corporate profitability, because that will impact the tax revenue collections of the government of India. So between these three things, as of now, see, the nominal GDP issue has an impact on the fiscal deficit and borrowings as a percentage of GDP. But these three factors that I'm talking about have an impact on the fiscal deficit at an absolute level. And that is something that for FY27, the extent that the conflict prolongs and the extent to which the availability and the prices of natural gas and crude oil, etc., get impacted, that is going to have a key bearing on how the fiscal plays out, especially in the first half of FY27, for instance.
Yep.
Now, in terms of FY27 borrowings, because we've seen a lot of conversions, etc., happening, the pressure that was felt on 1st of February in terms of the gross borrowing, that has eased off quite a bit. But obviously, the net borrowing number will now get impacted by the state of the fisc going forward. And for FY28, anyways, the pay...
Will there be borrowing? I just want that answer. Are you expecting higher net borrowing in FY27?
If the crude oil prices go up by, let's say, $10 per barrel on average, then yes, it would have some impact on borrowing.
Possible. Upasana, what about currency? What are your internal numbers now? Do we see 93 in a quarter, 94 in 12 months or 6 months?
So Lata, again, it's a scenario analysis we are all working with. But yes, if this problem was to persist, then clearly I think we could see a shift towards 93 to 95 range. Again, it's all about how long this problem persists. If within March we do see everything settle down, then I think we'll be back to where we were, a 90-92 range. But I do assign a reasonable probability that the first quarter also could see a 93 to 95 range, purely because the spillovers of the crisis and the kind of disruptions that it may cause may not settle down immediately. So I guess we might be seeing some kind of a persistent pressure even into first quarter. That is the reason I think we could see a shift towards 93 to 95 range.
Okay. Well, I might just end with a arithmetic salve for all this. If WPI and CPI were to go up a bit, then somebody in government told me that also means nominal GDP will go up. And that will mean, we can manage the fiscal deficit, borrow a little more without really disturbing the fiscal deficit number. Well, these are small consolations. We have to wait to see where everything settles down. Thank you very much for setting us thinking on what we should worry about. Upasana and Aditi, thank you for joining. Wrap up on Bazaar, Chartbusters.